call me, but they did something else here. Okay, so when we talk about a mortgage, what comes to mind? What comes to mind? Money owed? You don't own it. You obviously don't own it. And our joke is do you own your house? Yeah, the bank does. It's in my name, but the bank owns it. Okay, what else comes to mind on mortgages? It is something in our country we take for granted that everybody can get a mortgage. There are other parts of the world where mortgages don't exist. The mortgage, having a mortgage in the United States makes our real estate world work because most people do borrow money to buy real estate. Most people don't have money to pay cash. They only have a partial down payment. So the mortgages make our real estate market work. Mortgages are, they're an operation of what we do in our financial market that is very much governed. There's all kinds of rules and regulations about how mortgages are done. Consumerism at its best needs to be protected. Do y'all know what happened today in the government? Mr. Cordray gave his resignation today. Mr. Cordray, and he runs Consumer Protection Bureau. The federal government, the Consumer Protection Bureau.
He just quit.
He's quitting supposedly because he's coming back to Ohio to run for governor of Ohio. But while he was at the federal government, he's done a lot of things to return over $114 million to consumers' hands of how they were taken advantage of through mortgage lending, through banking practices, through student lending, and stuff like that. He's, quote, been the good guy for the underdog, who's consumerism. So it'll be interesting to see who gets put in that position again, and how much will they continue to work for consumers and protect consumers. It's an ongoing battle. What's going to happen is there too much regulation. And banks and insurance companies and other institutions will tell you there's absolutely too much regulations. Until you've been taken advantage of, you think no. So a mortgage, basically it's a written instrument that uses the real property to secure the payment of the debt. So it's the mortgage that's yours paying. The note is the payment, the promise to pay. Secured debts, a lender's risk is reduced by requiring security on a loan. So when we have secured debt, when you have a credit card, it's considered an unsecured debt. It means you can go and you can charge up things and you can buy things, and the things you buy, yeah, somebody could come back and take them from you, but the reality is it's an unsecured debt. It may be secured by your signature, a signature loan, period, but it's only they can come back to you. Whereas a mortgage is secured by the piece of real estate. The car loan is secured by the car title. So in the middle of the night, they can come take your car away. There's something that they can actually come back and take, and you promise the car against the title against the loan. So that's a secured debt. All other debts are not secure. A note is the written instrument signed by the borrower containing the provision of a loan and a promise to repay according to terms of the agreement between the borrower and the lender. So we have title and lien theory states. Ohio is a mixture of both. And you'll read more about what the title and lien theory are. They protect consumers that if there's a lien theory, there has to be a judgment in the court to do a foreclosure. There's a whole process to go through and do it. And I've seen that happen in Hamilton County. So that would say that this is a lien theory area, but Ohio, when you read through what title and lien theory are, Ohio is a mixture of all three, title, lien, and a hybrid. And it's not a bad thing. What happens, and we'll go through what the lien theory and everything is. The content of the mortgage, it's a two-party instrument where one of the parties, the mortgagor, creates a security interest in the property for the other, the mortgagee. So the mortgagor is the borrower, and the mortgagee is the mortgage company. The deed of trust. This is a long-term escrow agreement. It's a written instrument that transfers title to the real property to a trustee as security for a debt owed by the borrower to the lender, who is the beneficiary of the trust. When I took this class, to me, a deed of trust was all about what we call land contracts. It was basically a deed that was going to be held for a long period of time while payments were made, versus what we're doing today, where we, in Hamilton County, when you buy your house, you actually get title to it even though the bank owns it, you're living in it, you get title to it. You sign the mortgage and the note. The deed of trust, the deed somewhere in a third party until the loan's all paid. So then we also have the loan application and the commitment are part of this whole mortgage piece. When you get your paperwork in this file at a closing, you'll see your loan application and commitment are all part of it. They put it all back together for you in the file. The rights and obligations of the parties. Possession, the right to occupy and control the real estate to the exclusion of all others. So in our market, you own the house, you get the right to occupy and control the real estate. You get the right to all the rents and the profits. But the mortgage also says if you default, the rents and profits go to the mortgage holder. The mortgage holder can come back in, issue a letter, legal notice, to the people living in the property, start paying the rent to me. I'm taking over the property. You get protecting the security through hazard insurance. This mortgage you sign says that you're going to maintain insurance. You're going to protect the asset so that if something happens for the typical causes, fire, things like that, the asset can be rebuilt so that the mortgage company knows that if there's a catastrophe, there's an asset they can come back after. So typically the mortgage company says, we want to make sure that you're paying your real estate taxes and your insurance and escrow because we want to prove that you're making those tax payments and your insurance payments are current so that we are protected, the taxes won't lien before us, and that the property will be covered if there's catastrophe. What's your question?
I just wanted to ask, I know a lot of people escrow, like most people escrow their taxes and insurance.
Mm-hmm.
But then the people who don't escrow say, well, I don't like to see that big mortgage payment, so I just pay my taxes separately because they say it was cheaper for them if they do it separately.
Years ago, when we escrowed money and you'd go to a closing and you had an escrow account set up for your taxes and insurance, you'd sell your house, you'd go to closing, and the seller would get a couple $1,000s because the mortgage company had their money and they had to refund the gap of what they weren't using. Some of the laws today say these escrow accounts can only have a percentage of balance over and above what's actually due. So I've actually, because I pay my own insurance, but my taxes are escrowed, I get a check back every quarter from my mortgage company because I'm paying my insurance. And the mortgage company gives me a little statement that says we can't hold this much money in the account. So years ago, that was true. People didn't want to do an escrow because they felt like they were loaning the mortgage company their money and not getting paid for it, a couple $1,000s. Today, there's provisions in the escrow laws that say it can only be so much percentage higher than what's actually due. They're not really saving any money in the long run. It's their money. Either the tax authority or the insurance company is going to get the money, and if the mortgage company is holding the money and doesn't pay it, they have to refund it back to the mortgage holder. So they're not losing any money. It's just the principle of how the money's being moved around.
Right. So they're really not saving any money.
Not saving a lot. And the mortgage company likes it because they know for sure that the taxes and insurance got paid. But again, because I pay my insurance, my homeowner's insurance is paid with my auto, it's all one big policy. You save money by putting it all together. So my auto is taken out of my paycheck, my checking account every single month. And a piece of that is my homeowner's. So I'm paying that direct, but the mortgage company gets confused. And it never fails. They get confused. They screw up my escrow all the time. But I do get checks. Every quarter I get checks. It's like, oh, okay, I know what this is. So it's going to be paid one way or another. It's part of the cost of owning a house. You're going to have to pay taxes and insurance, either through the mortgage company or direct. But in order to do it, that's the other key. In order to pay it direct, you have to buy the privilege from the mortgage company. It can cost $900. So it's like, why would you? Just pay it to the mortgage company. Let them have it. Let them deal with it. It's not as easy to shop for your insurance, but you can do it. Because you got to notify everybody. Okay, so priorities. We have mortgages and leases. The mortgages and leases take priority over other things. Again, when they're recorded, they take priorities. We've given the world notice that there's a mortgage place, that there's a lease place. Mechanics, liens, and mortgages. The mortgage is usually recorded right after the closing, so the mechanic's lien is going to take the first place over a lien. But if the lien holders come in and record their liens before the mortgage gets recorded, we have a first come, first served policy here. And so whatever gets recorded first gets the priority. So the priority is, again, because we're Ohio, it's the first to record is the first to get priority, except for taxes that get very number one priority. Default. So all of our notes, instruments have default provisions. So when you're non-perform on a duty or obligation accepted by either party as part of the mortgage transaction, it can be considered a default. You can default by not making your payments. You can also default by not doing maintenance and repair. You can default by not keeping your insurance current. Those are all different ways the mortgage company come back in and say you defaulted. When you default, they have an acceleration provision, which basically says, hey, the mortgage is all due and payable now. They accelerate it. Now, it's not the total with all the interest. It's today's interest value where they accelerate it today. There's an equity redemption, which is the right of the mortgage or another person with an interest in the property to reclaim it after default but before foreclosure. This is one thing about where we're the lien theory area. We give more people more protection, more time to do redemption if the property is lost to a foreclosure. There's more time through our court system to actually do the redemption before it gets to foreclosure. There's a statutory right of redemption. It's the right of a debtor to redeem the property after a foreclosure sale. That doesn't happen in Ohio, but it does happen in other states. They give people up to a year in some states to come back in and redeem, which means they make full payment and they can get the mortgage released. But if you're an investor or you're a homeowner and you're trying to buy a foreclosed property, what's your incentive if somebody can come back and buy it for a year? You've lost, there's not. It makes the market real funky. It's hard to make it function and work. Boy's looking at me like, what are you talking about? Yeah, so I want to go buy a foreclosed property in another state and there's a redemption period for a year. That means I'm taking a risk for a year that the prior owners could come back and take the property back by paying off the loan. Yeah, you take a risk. In Ohio, we don't have that. Our redemption is up to the foreclosure period sale. Once it goes through the judicial process, redemption's done.
Now,
It's done.
That's what I was remembering. So.
Right. Yep. So foreclosure of a mortgage, it's a legal procedure by which a lender who has advanced funds with a real property security recovers in the event of default. Again, we are judicial foreclosure, the legal procedure in which a court orders the real estate sold to enforce the mortgagee's rights under the mortgage. So they will have a court hearing. The mortgage company has their attorneys there as the bank to represent the bank or the lending institution. You as the homeowner come to this hearing. You stand before a judge and the judge will talk to you, ask questions about what's going on with foreclosure. Why are you not paying? What's happened? Tell me your side of the story. Consumer, what's going on? Were you treated fairly by the mortgage company? Did you try to get the mortgage company to help you out? Have you exhausted all your resources? Mortgage company, they're simply there just for their attorneys going, okay, we'll wait for the question to be done and we're going to give papers and say we got a note. We have the right to come and reclaim it. That's it, period. It's done. But if you've gone to the mortgage company as a consumer and you've tried to get them to work with you and you've had agencies or other people involved to try to help you get your mortgage redone, they'll listen to that. And they may give you some relief, some time to keep working on trying to save it. The court does not want to see the property foreclosed. The court is there to try to protect the consumer. That's why we have these laws the way we do. So they're there to help, but if you haven't done anything to try to help yourself, the court will just kind of look at you like, well, you haven't helped yourself, so we can't help you either. So the foreclosure sale is the sale of security from which the proceeds are allocated to pay the expenses and the mortgage debt. So this means the bank owns it. They're having a foreclosure sale. The foreclosure sale typically is not going to get 100% of what's owed on the property. If they do get more than 100%, they have to give the consumer back what the equity is, and then they keep whatever's left on the note. But typically, it's less than what's left on the note. And then they can go back in. The next phase is deficiency judgment. The money judgment awarded to the mortgagee when funds obtained as a result of foreclosure are not sufficient to pay the debt. So, hey, sucker, not only did you lose your house for foreclosure, but now you have this deficiency judgment against you. It says you're still making payments on a house that you don't live in. And this is the reality of foreclosure. It's terrible. It is what it is. But the reason you as realtors need to understand this is when you work with clients that are trying to sell their houses, they're facing foreclosure, they need to understand what this picture is going to present to them. What are their options? So they have another option, it's called a short sale. We'll get into that here, I think, next. Not yet. Okay, short sale is another option. The non-judicial foreclosure is foreclosure based on terms of mortgage, giving the mortgagee or third party the power to sell the mortgage property on default without resorting to the judicial foreclosure. Ohio is not this. Ohio requires judicial foreclosure. Strict foreclosure is a judicial procedure that by terminating the mortgager's equity of redemption gives the mortgagee absolute title to mortgage real estate without the sale of the property. So they just come in and say, we got it, it's ours. I don't know how they get people moved out. They haven't been through a sale to get a sheriff there or whatever. There's some step where they're going to have to get the sheriff involved literally to move people out. Judicial foreclosure does that. It sets up a sheriff sale. It does all kinds of stuff to get you out of the house to take you down this road. Not a pretty road, but it takes you through the process. So the alternative to foreclosure is a deed in lieu. This is a procedure in which the mortgagor conveys the mortgage real estate to the mortgagee who promises in return not to foreclose or sue on the underlying debt. Typically, deed in lieu is something we saw in commercial real estate. We would see the deed in lieu. The commercial investor says, you know what? I'm sunk. I can't afford this. I'm not going to do it anymore. Here you go. Here's the deed. I'm walking away. I'm giving up everything I've put in the property. Here you go, mortgage company. It's yours. That's really what they're doing. They just give the deed back. That's a deed in lieu. We've seen deed in lieus in residential, but we more than often term it a short sale in residential. But we actually have short sales in commercial as well. Short sale is a term used to describe the event where a lender and borrower agree in contract to sell a property at a price less than the outstanding principal owed on the mortgage. So you're underwater. You know you're not going to be able to get back up there. You know you're going to lose the house to a foreclosure. So the alternative is rather than having a foreclosure, having a mark against you on your credit, you come back and say, lender, I want to work with you. I'll do this thing called a short sale. I'll work with you. I'll get out of the house. I'll get it cleaned up so you can market the property and sell. There are a lot of realtors that will not work with short sale properties in Ohio because the bank has up to 6 months to take offers. You find your customer, they want to buy the house. They've gotten their mortgage credentials approved. By the time the bank is there ready to say it's yours, they've got to go back through the remortgage application process again, because the mortgage is not approved for 6 months. It's approved for 60 days. So they've got to put more money out. They've got to have reappraisals. They've got to keep going through this process again to keep reapplying. The other thing, while that deed short sale is out there, the bank can take competitive bid. So you've gone in, you think you're buying the house, you're going to get it on a short sale, you're going to get a hell of a deal, you're going to get it for less than what's owed on it, and then all of a sudden somebody steps in and buys it on top of you because they gave a better bid to the bank. And you don't even know it's happening. You just find out like close to the time you expect there's a closing, the bank all of a sudden says, hey, we got a better offer, we're selling to them instead. So there's a lot of uncertainty in this whole short sale process. So there's a lot of brokers that don't like to work this end of the market.
So the bank can't continue to accept offers even if they already accepted yours?
Yes. They've conditionally accepted yours, and you're on the line, you're waiting, you're hoping you're going to close, and all of a sudden somebody steps in and gives a better offer. Yeah, and then you just wiped out.
So, but if someone can step in and give a better offer, what's the difference between that scenario and one where they're auctioning?
It is basically an auction. It is, but people don't understand that's how the short sale works. They think if they put an offer in on the short sale, they're guaranteed they're going to get it. And they're not guaranteed.
So can you then rebid?
Yes, you can rebid, but very often you're already
Right,
you're where you want to be. No, I don't know that, but typically that's what I've been told. And I have not been involved directly in a short sale, but I've heard a lot of realtors say, I go to the ethics and fair housing type things, and that's where I hear the other realtors absolutely, not going there. As much as I like to do real estate, I will not do a short sale. That's what the realtors will tell you. They won't get involved in them.
What if they wait till like the very end of the 6 months and then do it? That way the 6 months period.
You're still courting this client that thinks they might get something and they ultimately don't. And that's why, or you're the realtor representing the sellers that are trying to sell the house, and it's all whacked. You don't know what's going on. It's out of your control. You're giving the control to the bank. The banks are bad managers. They're bad managers of the real estate. They're bad managers of this whole process. They just don't do it well. And a short sale, the idea behind a short sale is the same thing. It doesn't appear as a mark against your credit. That's why people are incited to want to do a short sale. But the problem is when the bank sells it short of the mortgage, the gap between what they sell it for and what you owe is either income. So you get an income statement the next year, the W-2 that you didn't realize you're going to owe taxes on, or they can come back on a deficiency judgment and still ask you to pay the gap. So that's another thing that typically in a short sale, when people agree to a short sale, that's part of the negotiation with the bank. What are you going to do with me? Are you going to give me the income for the gap, or are you going to come back after a deficiency judgment? That's one of the reasons they want to work to this. They get the guarantee there's going to be no deficiency judgments, no back credit on their rating, and they deal with the taxes when they have to. They'd rather deal with an income tax gain than deal with bad credit and a deficiency judgment. You're in hard times. And to me, unfortunately, short sales in the appraisal world get considered in appraisal comps, and they shouldn't be. Short sales should not be part of appraisal comps because that's not a true arm's length transaction. Somebody bought it, but to me, that's not a true arm's length transaction.
Wouldn't somebody just be better off like calling up like Susie Klein and just having one of their realtors come over and try to sell your house? Would that be just a regular sale?
But the problem is when you're selling short, you're never going to pay your mortgage in full. You owe more than what you think you can get for it. You're underwater.
So you couldn't get off, so it wouldn't be good.
Yeah, you can't go to a realtor and get it sold and get out from underwater. You're sunk. You owe more than what the house is worth.
So do they expect the deficiency in a lump sum?
Depends on how they work it out. It can be lump sum or it can be over time. But again, most people settle with the bank to say it's not going to be a deficiency judgment. I'll get a W-2 and I'll pay income tax on the gain. But again, short sales aren't all what they're cracked up to be. So my advice on this is if you get involved in short sales, and we used to do a whole lot of them, the mortgage market is turning around. We don't have so many people underwater. We won't see them happen as often. But get experience doing it. If you're going to do these things, work with a realtor that's done it. Have somebody show you the ropes of how it's done so you know the ins and outs, and you'll be able to explain it to your clients. Basic types of mortgages. There's something called a purchase money mortgage. There's construction mortgages. There's open-end mortgages. There's wraparound mortgages, and there's package mortgages. Most of these we see in the commercial world. Some of these we see in the residential world. I'll let you read about them and see what they are. You don't need to know all the ins and outs of every type of mortgage for a test. What you need to know is that the fact that there are other mortgages out there and what a mortgage is. That's really what you need to know for the state test. The fixed rate mortgage, the adjustable rate mortgage, the balloon, the graduated, the reverse annuity, and the subprime. Okay, I'll go down the bottom one first. What do you all know about subprime mortgages? What did you hear about subprime? They're bad. And why are they bad?
They have a high likelihood of
Default?
Yeah.
High likelihood of default? Huh? Higher interest rates? What? Exactly. That was the biggest piece. Mortgage banker brokers were making a ton of money by, quote, selling the mortgages, and they were giving them to people, they never qualified them. They weren't making sure they had a job. There was just all kinds of things that were whacked about the whole process that they weren't doing. So, but these people were higher credit risk. They were charging them more for it, but in the subprime mortgage, they also had something called the ARM. So these people were in subprime already. They were already in trouble when they got the house. And then they had this thing called an adjustable rate mortgage that in December or January, September of 2008, all of a sudden their mortgage payment went up a couple $100 a month, and they couldn't afford to make the mortgage payments anymore. They had to walk away. So an adjustable rate mortgage is a mortgage that literally adjusts, cranks up. They're fine for the marketplace. If you know how to negotiate adjustable rate mortgages, they're great. They work well. But the things you need to do is there's a teaser rate that's offered to people to get them to take this ARM mortgage. It's lower than the market. It goes up. But as a consumer, you can put caps. You can negotiate caps so it only goes up so much. It's going to be a little higher than a straight, flat, fixed rate mortgage. But early on, it helps you out. It can make your payments less. So as long as you understand what the adjustable rate mortgage is, how to use it to your benefit, it's a great tool. It does work. They're not all bad. A balloon payment mortgage is exactly what it says. Typically, they're interest-only loans. And after 5 or 10 or 15 years, you're going to balloon. You're going to have to go out and refinance it. Very often, commercial enterprises do this because they don't expect to own the property 6 to 7 years for investment purposes. They're going to resell it anyway, and they'll just pay off the loan and move on. Graduated payment mortgage is just like a graduated payment on your student loan. As you make more money, you pay more money. Reverse annuity mortgage. This is the one where my mother-in-law just cringes whenever I talk to her about it. She doesn't need it, but it's something that older people do need when they want to be able to live in their houses till they die. They do reverse annuity mortgages because they want to pull all their equity out of a house. They want to be able to use that money for their medical long-term care so they can live in their house. That's typically why people are getting reverse mortgages. Sometimes they do use them so they can go travel, they can do their bucket list or whatever. They're using the equity in their house to get the money out of the house. If they don't want to sell it, they want to live in it. But the idea is to be a reverse annuity mortgage, you have to be over 62, and you need your idea is you want to live in the house at least 6 more years. So you can call anytime and get online or through the late night TV, you'll see ads for this, and you can call and get a kit that'll explain the reverse annuity mortgage to you. The reason why older people don't like them, they're scared of them, is what's happening with reverse annuity mortgage. You're borrowing the equity against yourself on your house, and when you die, there may not be equity left to give your children. But when, let's say you take out a reverse mortgage and you've only been there alive for 2 years and you die all of a sudden, but you only took out 1/6, 1/8, 1/10, 1/2 of what that mortgage was going to be, there's still equity left in the house. The equity's not all gone. So the reverse mortgage company, when you die, when it's time to sell the house, they do give equity back to the family if there's still equity left. It's not like you've signed it all away just because you've signed up to get it. It's how much was paid out that you got versus how much is owed on it. So they're not bad. They do work, and the reason they're there is it's people that don't have 401s or don't have retirement pensions. They use their house. They bought their house. They own their house. They're using their house to live on the rest of their lives. There's nothing wrong with that. That's part of the reason for owning a house in America. No matter who you are, you're building equity. You now have your biggest investment vehicle you may own in your life, and you're using it to help finance the rest of your life. Nothing wrong with it. You just need to understand how it works. Mortgage insurance is insurance provided by certain government agencies or private corporations protecting mortgage lenders. It doesn't protect you as the borrower. It protects the mortgage lender. The mortgage lender makes you get mortgage insurance if you're borrowing 20% or more on your house. Once you go below the 80%, then you go back to the bank and say, take my PMI off my mortgage. But most people, when they go in and buy a house, they're borrowing up to 95% to 98% of the mortgage price, of the price of the home. So they're going to pay that private mortgage insurance until they buy the balance down. It's conventional mortgage insurance. There's FHA insurance, and then there's also the VA guaranteed mortgage. So these are other pieces that are out there, other players. They're in the mortgage market that help people guarantee loans. If you're a vet, the VA is the best thing to use. You can buy a house. What is entitlement today? 400 and something thousand? Yeah, but it's up to $400-something that if you're a vet, you can buy a house with nothing down. Now, why would you want to mortgage that? If you got a good job, yeah, you can deal with nothing down because you're borrowing at a lesser rate in that cash. Rather than putting it in your house, you can use it for other investments. There's other things you can do it. The mortgage is the lowest borrowing rate that anybody should be able to get. So you borrow as much as you can on your mortgage. You use the other money that you put on your house and use to pay off other debts or do other things with it. FHA insurance, similar kind of deal, but FHA does have maximum income levels. You don't have to be dirt poor to do FHA. FHA can be mid-income as well, but the FHA guarantees the house payment.
Do you like the 203K program?
I never played with it. But I know, again, you don't have to. Middle-income people qualify for FHA mortgages, and they don't go there. They don't look for it to use it. Again, if you're out there selling real estate, learn what these mortgage programs are. Know when you're dealing with people if there's a certain level house they're trying to buy. They're a young couple. They're trying to buy a $150,000, $200,000 house. They probably don't have a lot of income yet. They may qualify for an FHA mortgage. It may be their best bet to get into a house if they're not a vet. So again, you need to learn about these programs. Laws that affect mortgage loans. This is consumerism. We have usury. It means you can't charge over and above certain rates. Illegal charging high rates to lend money. The Truth in Lending Act. You're supposed to know what the finance charge is, what the APR is, what credit advertising is. Yield spread premiums. This is what the bank makes. When they lend you money on your mortgage, they're looking at the yield spread, the money that they're going to make to lend it to you. They can lend it to you or they can lend it to somebody else. They're looking at the two deals to say which one is the better yield, which is our better bet as an investor. So you'll learn a little bit about what does the mortgage company make on yield spread. Equal Credit Opportunity Act. If you're denied a loan, they got to tell you what agency denied the loan so you can go back and try to repair your credit. They don't have to give you the loan, but they have to tell you where they got the bad report so you can try to repair your credit. Real Estate Settlement Procedures Act, again, telling you up front what are the costs of loans going to be. They're supposed to give you paperwork and within 3 days of a loan application, tell you what the loan can be and guarantee some of the information in that. The U.S. Patriot Act, again, it's supposed to be non-foreign money, people that are using it for acts of aggression or things like that. I do OFAC checks with all of my tenants and my vendors. Every quarter I submit paperwork for OFAC to make sure that they're not using money the way they shouldn't be. Predatory lending practices, again, what are lenders doing? There's a lot of things out there that try to protect that. It happens, but there's a lot of consumerism that protects that. Housing Economic Recovery Act of 2008, you'll read a little about that, and also, again, more of the predatory lending practices that happen. Again, not a lot you need to be concerned with for a real estate exam, but when you're in the business and you're working this, you'll see this kind of stuff go on. You'll see requirements that happen. You'll see information given to consumer as a result of these laws and practices that are out there. And you're going to say, oh, that's why they did that. And that's why they got that information, because there's an act that says they should get this. Sale of mortgage real estate. So we used to have mortgages that could be assumed. You still have assumption today, but rarely. What's typically happened is there's a due on sale clause in the mortgage that says that as soon as the property is sold, the mortgage has to be paid off in full. It can't be assumed. The next thing that happens is a mortgage assumption. It's a contract between the grantor mortgagor and the grantee in which they can agree to assume the responsibility for the mortgage debt. We used to do loan assumptions along a lot in the 80s when interest rates were 12, 14%, and you got into your mortgage in the late 70s and you were down below 10%, you would let somebody assume your mortgage at a lower percentage so that they could buy the house at a lower mortgage rate. Again, we don't allow them to happen a lot, but they're still there, but most notes say no. Novation is a mutual agreement which a creditor agrees to discharge an existing debt and substitute a new obligation and a new debtor in its place, so they can assign your debt to somebody else. That would be like getting your parents to sign on your car loan. If you default, your parents are going to pay it. That's the kind of novation that happens. Subject to refers to a sale in which the buyer agrees to purchase property subject to the lien of the mortgage. So, and we have more subject to than you realize. People buy properties with liens on them. You can buy properties with liens on them. You can buy properties that have title defects. It's just that when you buy them that way, you buy them with those defects there. You just know it happens. And usually what happens over a period of 6 months to a year to 2 years, you work with an attorney and you clear these defects. Subject to the mortgage, subject to the lien of the mortgage, at some point in time, you're going to have some guarantee that that mortgage will be paid off in a window. You'll know when things are going to happen.